Welcome, and thank you all for joining us for this episode of the Crexi Podcast, an insider's look at all things commercial real estate. In this show, we cover a broad range of topics that cater both to CRE newcomers and industry leaders alike. I am your host, Shanti Ryle, Director of Content Marketing here at Crexi, and today we are so excited to sit down with Aaron Fragnito of People's Capital Group. Before we dive in, a little bit about our guest. Aaron has been in real estate for over 10 years and has transacted over 250 real estate deals to date. He is a well-known name in the real estate investment industry throughout New Jersey, beginning his career as a realtor and transitioning to the investment side in 2013. He now helps people get started and build their wealth in real estate investments. Aaron also hosts the New Jersey Real Estate Network, the Cash Flow Podcast on YouTube. And Aaron also in the past wrote and taught a course called Real Estate Entrepreneurship at Rowan University. Aaron, welcome to the podcast.
Thank you, Shanti. So glad to be here. What an honor.
Yeah, we're so happy to have you here. We've got lots on the docket to discuss today. But just to get us started, I just read off your bio, but in your own words for our audience, why don't you tell us a little more about yourself, how you got started in commercial real estate, and, what's your journey been so far?
Sure. Well, I read a book called Rich Dad, Poor Dad, as every real estate investor has to do before you get started in investing in real estate. And I read that in my senior year of college. This is like 2009. I'm an entrepreneur major at Rowan University at the time. And, I'm a broke college kid trying to figure out what I want to do with my life. And I read that book, Rich Dad, Poor Dad, and it just changed my understanding of wealth creation and what I wanted to do with my life as well. It sparked a passion inside me I didn't really realize I had at the time, which was to own a large-scale real estate and build a real estate investment company. But I had no idea how to do it, and I had no money. So I moved to Steamboat Springs, Colorado, and I taught kids how to ski for 6 months, had a great time with my buddies out there, and read David Lindahl and Trump University, and they all made it seem so easy. You just go out and raise some money and buy some real estate, and bada bing, bada boom, as we say in New Jersey, you got yourself some real estate. So I moved back to Jersey in 2010, and I made a list. At the top, I said I want to have a net worth of $1 million and passive cash flow of $100,000 a year. And I wanted to accomplish that over the next 10 years. So that was at the top of the list. That was the goal, and I kind of worked my way down. I need to make connections, learn the business. I said, okay, I'll get my real estate license. I'll become a realtor to start. So got licensed June of 2010, started stapling signs to telephone poles that say, "We buy houses," got into the wholesale business of real estate and the realtor side of the business. And, I really struggled. I made about $500 my first 6 months in the business. It was a dismal market. Realtors say they struggle today. You should have tried being one in 2010. No one would call. You list a home, no one would call. The price would literally drop every 2 weeks. You'd look at the comps again and be like, oh my, it was dropping like a stone. It was crazy. So I finally made a $5,000 commission. I go up to my broker and he hands me a check for $500. He said, read the fine print. And I learned then you got to work for people that are trustworthy and inspire you to do better, not steal from you. So I jumped around different brokers for a couple of years. I found my place at RE/MAX. I built a team. I learned short sales. I worked with a short sale negotiating company and learned REOs and just met a lot of investors. I started a real estate networking group called New Jersey Real Estate Network, which now has about 5,000 members. And I started speaking at different RIAs, real estate investment associations, as much as I could, and anyone who would have me. And I just spoke a lot, and I started flipping houses and raising capital from private investors. And then I met my business partner, Seth Martinez, actually speaking at one of those RIAs. And we bought a 6-family together in Newark, New Jersey, which we still own to today for $220,000. Now it's probably worth about $1 million many years later. And we found it from a "We Buy Houses" sign. I used to staple the telephone poles in my suit and tie in the middle of summer for some reason. Yeah. Oh, gritty. I'm one of those guys. Yeah. And I would get like yelled at they'd be like, take that down. The police would come. Oh, man, it was bad. Only in certain cities. Yeah. A couple times.
Yeah.
So it was good though. They really worked back then. They don't work as well right now, but back in that market, no one was buying houses. So you put a sign on a telephone pole that said, we buy houses. The phone rang. And a year later, we refinanced our money back out of that 6-family. And that was the aha moment. I was like, wow, I could buy real estate, I can renovate it, I can lease it up and refinance all my money back out in like a year or two. This is amazing. And back then, man, they were just giving it away. You could buy real estate for great prices. So Seth and I teamed up. He had sold a medical billing company. He had a little bit of cash. I was great at finding deals. I was a realtor and a wholesaler. Seth was good at operations. I was good at sales. So we teamed up. We started raising capital together. We started buying bigger and bigger properties. And now we have about 40 million in assets throughout New Jersey, a management company we developed through the years. And we're working with family offices and working on institutional capital as well, and just increasing our capital raising capabilities.
Yeah, that's quite the trajectory you've got there, especially with a commission of only like $500 out of your first deal. So, I mean, kind of you gave us the broad strokes, but from that first deal in 2010, in a really tough market where people were not making deals happen, what do you think kept you going during those early days? And how do you think you convinced people to, trust you to go with their money in this really tough market to eventually build out those first few deals and, build your business into what it's become today?
Well, transacting real estate and raising capital are two very different things.
Very true.
Right? And
very true.
And it took me many, many years. I'm probably just like a year ago that I really realized the different, in the different sales strategies there.
I guess I'll refine that. What do you think about you made all these different folks involved in all the deals you've done go with you, especially in a really tough market and especially in the beginning of your career? Do you think you had any innate skills or things you really had to build up that have served you really well?
I think people saw momentum. I remember I had like 14 short sale listings, a year and a half into the business, when a lot of realtors were just throwing in the towel that had been doing it for years. Sure. And I was like brand new. I had good public speaking skills. I was always comfortable speaking publicly. It's definitely one of my natural talents. If I really perfected it, I'd probably be even better at it. But I've always been very comfortable in front of a stage. I just turn on, but give me a microphone and a group of people, and I'm very comfortable. And people see that. And having the ability to speak publicly is a priceless talent for any business, but especially raising capital. And if you think about it, so much of what we do is public speaking. In sales, whether you're meeting with 1 or 2 people, that's still, in a sense, public speaking, or there's a room of 2,000 people. It's a different strategy, but it's, at the end of the day, it's still, you got to know what you're talking about, speak with confidence and clarity, and have passion in your words and your message. And even though when I started in this business, I didn't know what I was doing and I didn't have a ton of experience, people saw that passion and they saw that confidence on stage, and they want to get a piece of that, and I think that really helped me raise capital. I also had deals. I was working very hard. I mean, I would get up early and stay up late. I was going for it. I mean, I still work hard, but I definitely I worked 7 days a week back then. Like, one of the reasons I stopped being a realtor is because I needed a work-life balance, and I got married and had a child, and I couldn't just blow, 12-hour days, 7 days a week. Like, I need to have a balance in life, so, I worked really hard. People saw that. I had great deals, and I structured their investment in a safe way, normally in a debt structure, where they'd come in as a private investor. I'd secure their money on title, or I'd sign a promissory note. I'd give them like 18% interest. I made it pretty attractive to get in on our deals, and that was the first types of capital I raised.
Nice. Very nice. Yeah, it's all about being as creative as possible and transparent as possible, and it takes a lot of work to do both of those things sometimes. So, kudos to you for starting right out the gate with that kind of mentality. So, something we talked about in our preparation for this call is that you've been very open with mistakes you've made in the past in your career and like letting others learn from those mistakes. Do you have
Mhm.
any favorite mistakes perhaps that you could share with our audience that you think really course corrected you or set you up for future success later in your career?
I mean, I've made so many mistakes, so many more mistakes than successes. I think failures make us who we are. Most of them were around the area of hiring the wrong contractor. I think the
Mm.
basis of like 80% of my mistakes were hiring the wrong contractor. I remember the first fix and flip I ever did. I hired a contractor who we didn't like know his first name. I think we called him like Mr. Jones or something like that. Yeah, and like then I think his first name was Rick. Anyway, he did a very shoddy installation of all these materials, and then I paid him, and he never paid the subcontractors.
Oh.
So the subcontractors never got paid. So they still had the key to the house, and they went back into the house and took everything out. All the materials they installed like overnight. So I'm like getting ready to list this property on the market. It's all renovated. And I'm driving up there to get there. Everything's gone. The plumbing is ripped out of the walls. The flooring's gone. The appliances are gone because my general contractor never paid the subs. And this guy basically ran off. I took him to small claims court. I won. Then what they don't tell you is you can win in small claims court, but then you need to collect on it.
Yeah.
And he showed like no income. He ran everything through like his wife and like his sister. And so I never was able to collect any money from the guy. Mm-hmm. Then I hired another contractor who was like decent, I suppose. And then I learned dealing with the town. And we were like changing the heating system over. We had to get all these load calculations and engineering drawings and airflow, and it was like a nightmare. Mm-hmm. And I, by the grace of God, only lost $7,000 on that first flip. Which, if you think about it, I mean, people pay like $250,000 to go to college, and here I am getting the lesson of a lifetime for $7,000. I mean, a lot of these, guru courses are like $20,000, right? So hey, $7,000, I'll take it, And when it was like 2 years, a lot of the money invested was like friends and family. Thanksgiving was tough, right? I totally blew it, and then I like blew it again, and then I blew it again, and then like the septic failed, like everything, ever could go wrong. Other times I've lost money in real estate. Again, wrong contractors. I've brought in like inner city contractors who were great at like renovating, doing like basic renovations, and brought them in like multi-million-dollar homes. Mm-hmm. And they completely overpromised. They had no idea what they were doing on pricing. They would like gut the whole thing and then like completely underestimate how much it would be to like renovate a high-end building, a high-end single family home. And it'd be like 3 or 4 times what they initially told us. And their work was just not good. Mm-hmm. So, challenges like that generally led to losses in a few fix and flips there.
Everyone needs to listen to these stories because it will save them a lot of money in the long run, it sounds like.
Mm-hmm, mm-hmm. And one more too, while we're on the failures, I mean, I could go on and on here. The lending documents, we would use private lenders who would like send us like no invoices, like no updates, like nothing. We would sign a note with them, right? And then like the interest would accrue. So if a project, like some of these projects that were really messed up, it took like 2 years, they would come to us with their final payoff statement at the end of it. And it would be like, by the way, interest went from like 12% to like 26% like a year and a half ago, read the fine print. And we'd be like, you didn't think you needed to notify us when interest like more than doubled? They'd be like, no, the promissory note says it. And they were right. So we would have to like negotiate with the private lender. So stuff like read the notes you're signing, hire the right contractors.
Get a lawyer.
Yeah. Get a lawyer, right? Know what you're getting into there. So yeah. And I had like different high net worth individuals who invested like lots of money, and they would then like not cooperate with stuff like as partners. So that's why we started doing GPLP structures.
Yeah. It sounds like, you really got to do your due diligence within the terms of the deal, not just as
Mm,
part of the deal itself. Who are the people involved? Who are the players? To what extent are you tied up with them
hmm
from a financial or business perspective? And don't skimp on
hmm
legal
Yeah.
representation.
Oh, no, no, do not.
Absolutely.
Spend that money.
So, speaking of all these mistakes and passing along these lessons, how did your experience teaching at your alma mater uh, kind of, either inform your career, having to go back to basics and pass it along, maybe reinforce early lessons learned? How did you think about creating that curriculum, and what did that teach you about your own business as you had to put those ideas together for students?
Yeah, that was a great experience going back to Rhodes University, a decade later, and being asked to write and teach a course called Real Estate Entrepreneurship. And it was so good for me to do. It was a lot more work than I thought. I only did it for one semester because of that. And at first I was like, no, I'm not going to do this. I don't have time to do this. And then they called me up like 2 weeks before the semester, like no one else could do it who's actually running a real estate investment company. We really want you to do it. If you don't do it, the course isn't going to happen. So I was like, all right, I'll do it. They pay like $5,000 for the semester. So it was just, it was great though. It was a great experience. And I learned so much reteaching what we do. I had to really go through all of our underwriting spreadsheets. I thought about it like, how do I what do I teach? Is it flipping houses? Is it syndicating apartment buildings? Is it raising capital? Is it structuring debt and equity? And I made the mistake of being like, I'm going to teach all of that, and one semester, so jammed way too much into the course. They always say when you write and teach a college course the first time, it's like a trial run, and they're right. Like if I should probably have done it all over again, cut out half the stuff, and you really actually want to break it into more particular courses. Like I could do a whole semester on fix and flipping properties. I could do a whole semester on real estate syndication. I could do a whole semester on raising capital. That's really branding and deal structure and marketing and sales. But it was good. It was kind of a crash course on everything. And I covered a lot, from IRR to, dealing with contractors. And it was good. But I definitely made the mistake. I was like, I'm going to be an interactive professor who gets them out of their seat, because I used to hate in college how you just like sitting there, like talking to you for 2 hours. And at the end of the day, it was hard to like engage them in different ways, because I was like, I have so much information I need to explain to you, and I have so little time. I'm just going to go like this and this, So I should have done more interaction with the students. I should have condensed it into less information and just focused on lesser topics. But they have the course. They can update the course. I got great feedback from the students. And for me, it taught me a lot about my business as I was reteaching it to students.
Absolutely. Yeah, I think a common thread I hear is that there's wonderful commercial real estate programs out there at universities these days, but the real world experience sometimes doesn't translate into a classroom setting. So you being able to share your very real stories of hiring the wrong contractors and working with private lenders who didn't keep you up to date on things, like those are things that it's very valuable if a student can hear about them first as opposed to live through them. So before we hop into, more talking about company building and investing, what advice would you give a young 22, 23-year-old getting out of college, or even your 22-year-old self about getting into commercial real estate?
I would say focus on one strategy. I was a little all over the place. And you can look back and say that gave me a breadth of experience and allowed me to now be able to understand, everything from fixed and flipping a $60,000 home in Newark to fixed and flipping multi-million-dollar homes in Morristown, New Jersey, to buying large apartment buildings. But if I could go back, I would just learn real estate syndication, raising capital, sales, and buying and managing and repositioning apartment buildings. And I probably would have just nixed the buying smaller stuff and fix and flips and so on. But it's hard to say because a lot of those experiences were great. I bought land. I've sold that to builders. I mean, we went to sheriff sale auctions. We did like 100 sheriff sale auctions over like 2 years and made like well over $1 million in assignment fees and wholesale fees. So there were a lot of good years of doing different things in real estate. And I think now when people invest in me, because people invest in people, they don't invest in deals. Deals matter, but people matter more. They say, oh, this guy's done a lot of different things, wholesaling, fix and flips, apartment buildings, capital raising, deal structure. And I've done like 300 plus. I got to update my bio, by the way. I said 250. It's been like 300 plus deals. So
300.
Yeah. Note that there. In New Jersey, right? Like all Jersey. So I know this market well, and perhaps I wouldn't know as well, but if I didn't do all that, but I would probably be more wealthy and have a couple more zeros in my bank account if I just raised capital and bought apartment buildings and didn't get off track with different rabbit holes or whatnot, different strategies.
Sure. Yeah. If you're lucky enough to figure out what your specialization is and what you're really passionate about and focused on early on, you definitely have a leg up. But, you're just getting started, right? So let's get into the brass tacks because you said, if I were starting over, I would learn this, the sales, the prospecting, the raising capital. Brass tacks, let's do it. You mentioned early on, like you had 15 deals in your first year working as a broker, and you've done, like you said, 300 deals now in the 10 years since. So all of that comes from some kind of networking, whether it's cold calling, whether it's referrals. How do you think about building your prospecting operation, and how have you evolved that strategy from the beginning of your career to now at scale?
Okay, so let's talk about sourcing deals, right? So there's two essentially, right, through your network, right? So there's two different primarily types of deals that we buy. We buy smaller properties. We still buy fix and flips. We still buy land. We still buy small multis, 6 units or less. And we'll buy those through our debt fund that investors invest in and earn a nice quarterly interest payment. A lot of investors like the debt fund. To find those types of deals, there's primarily two ways. It's marketing. Marketing takes money. This is direct mail marketing, telemarketing. Both of those strategies will get you deals if you have a good list and a good marketing piece and a good marketing company that you're working with. And then the other strategy is networking, working with wholesalers and realtors and so on. Now, that's not as good in today's market because the buyer's market is so hot. You're bidding against other investors generally, okay? And residential deals are like super in demand right now. There's a lot of people that can afford to buy residential deals because they're cheaper and you can leverage your money and so on. And you have a big buyer pool, right, going on. So we find direct marketing to get our own deals is the best way to buy small opportunities, okay? Now, if we're talking about apartment buildings, anything, we buy 50 to 100 unit apartment buildings within an hour commute to Manhattan in North Jersey. Okay, we have a very specific buy box. First of all, you should always have that with whatever you're investing in. You'd be like, oh, I buy all over the country, any type of real estate. No, you're not like a multi-billion-dollar fund. If you're a small shop, you got to have a strict buy box. So to get our deals on the large scale opportunities, we work with brokers. Okay, generally commercial real estate. If you're selling, a $15 million apartment building, you're not going to like call a We Buy Houses sign. You're going to work with like a broker. A serious broker, and there's buying brokers and there's selling brokers. So that means that there's brokers that when they get a listing or they're about to get a listing, they call up a guy like me and they say, Aaron, I got a great deal for you. I know exactly what your buy box is. You got a good reputation on closing. Maybe I've already closed deals with them. I don't waste their time. We can move quick and so on. Here's the deal. Here's the best price the seller will take. Maybe I can get them down more. Here's the numbers when he come out and see the property. And then I'm the only bidder on the deal. Okay. That's how you get properties at great prices. When you're the only buyer in the room, that's when you make your money in real estate, and you make your money when you buy. So that's how big deals are done. Now, that's a buyer's agent. He kind of favors the buyer. Okay. So when I go to sell my apartment buildings, now I've repositioned them with my in-house management company. I've got them stabilized. They're moving nice. We've made refinance, got a lot of money back to the investors. A couple of years go by. Now it's time to sell. So I'm not going to call up that buying broker, right? He works for me to like source deal. He doesn't work for me, independent contractor, but he's great at sourcing it. Well, you don't want to sell your deal that way. You want to go with a listing broker. Now, listing brokers suck when it comes to buying deals because they blast it out to hundreds or thousands of buyers and they get a bidding war going. And I hate that as a buyer. That's not how I buy real estate. But if I want to sell my property, I'm going to go to brokers that favor the seller. And they're going to normally a big name, CBRE, Cushman and Wakefield, Marcus and Millichap. A bigger name with a big brokerage behind them with a Berkadia. We just listed a deal with Berkadia. And you want to make it fit. Like if you have we just listed a 25 unit with Berkadia because they're kind of focused on like small to mid-size apartment buildings. Where if I had like a 200 unit, I would list it with CBRE because they're more like institutional grade buyers. So you got to know your commercial brokers and what they specialize in as well. But you want to go with a selling broker who's going to create a great marketing piece, a great OM, offering memorandum, also known as a deck, and they're going to put that out to their huge buyer pool, and they're going to sell that deal for top price. They're going to get you a bunch of offers, and that's how you sell deals. But again, I would go to that guy to buy deals, only to sell deals.
It's all about the exposure, and your niche. You know how you will be adding value to what you put into your portfolio. So that totally makes sense. You'd rather just get to the easy part one from a buying perspective. So a lot of working with brokers in particular is about the relationships, especially, not even just brokers, working with, financial sources, working with the other components, working on a deal like lending or, a title company. All the different components have to do with relationships on a deal. And like you said earlier, people invest in you, not as much the property, though it is the property, but the people behind the deal is a huge component of it. So how do you, when working at scale with all these deals, think about continuing to nurture and strengthen those relationships, build new ones, like you said, with the prospecting side? And how does that all play back into who you are, who your company is, like as a brand?
Yeah, brand is incredibly important. If I could go back to 22-year-old Aaron again, I would say create a strong brand and stick to it. You can't be everything to everyone. My mother always said you can please some of the people all the time and all the people some of the time, which is a great message for branding. You're not going to get all the people. Who is your avatar? The guys that do the best in fundraising are like a dentist who helps dentists create passive income. Or in our case, I'd say our brand is New Jersey. We are New Jersey market experts. Now, we have investors all over the country, but for the most part, like 80% of our investors are in the tri-state area. Or they grew up here and then like moved to Georgia or like Florida. A lot of people move to Florida from Jersey. It's just what you do. But they grew up here, or they went to school here, or they worked here for 20 years. They know, they see what happens in Newark, New Jersey. They want in on that. Jersey City, they want in on that. So that is our brand. And a lot of syndicators go to Dallas, Fort Worth, or the Sun Belt, or North Carolina, and they just kind of follow this trend that like everyone else is doing. And I don't think that's the way to go. You got to create your niche. What do you offer? Like, there's not a lot of syndicators that offer North Jersey vintage real estate opportunities. Most of the people are just following what the crowd does because, the Phoenix market, whatever, because it's in the headlines. Oh, this is where the jobs are going. This is where the factory. Fine. That's all good. You can have but you got to have a why. You know, I grew up in Jersey. I know Jersey. We've done hundreds of deals here. We get off-market deals that are not sitting on the internet. No one's ever going to see the deals we get. These are great deals, and we have the team in place to reposition them. And we have contractors we've been working with for, you know, many years who we can trust, and we can effectively lease these properties with our leasing staff and so on. And that is a boots on the ground niche shop here that allows people to really take advantage of something they don't have. Where if you live in, you know, Washington State and you're going to be like finding great deals in like Dallas, Fort Worth or something, you're just like starting off, like, don't do that. But buy around you, build a brand around you. You know, I think the local real estate is local. You got to know your brand, know your market. And we are Jersey. That's what we represent. You know?
Yeah. Yeah. It's location, location, location in many different senses of the phrase, right?
Yeah. Yeah, absolutely. I mean,
yeah. So speaking of these people investing in these great deals or specifically looking at New Jersey, that is who you are. You know, stewardship of that capital is really important. So what systems have you put in place to, you know, be as transparent and as accountable as possible to your investors? And, you know, in the event that you run into a mistake, which, you know, like you've shared does happen, how do you think about communication and, you know, really involving this investor group with what's going on so that you can continue to build upon that trust?
Yeah. Well, communication is everything. Communication is more important than performance. Okay, that's a good one. You should write that one down. Communication is more important than performance because at the end of the day, you're always going to have challenges no matter what. And what investors hate is when you're not communicating with them, whether it's good or bad, but especially when it's bad. You know, some operators think, oh, when it's bad, I'm not going to tell them anything. No, you got to disclose what's going on, but come to them with a solution, not just a problem. You know, the contractor didn't show up. We're behind on the project, but we just got 3 quotes from other contractors. We really like this one. We plan on hiring him by early next week to get the job back on track. You know, have a solution when you come with your problem, right? And have data to back it up. You know, every single month I send our investors a detailed monthly report of exactly what's going on with their property. I tell them it's included also with a rent collection report, which is printed right off of AppFolio, which is the software we use to manage our assets. So it's a professional report of rent collections on their asset. And every quarter we send out financials, in-depth financials, balance sheet, profit and loss statement, distribution statement. Distributions are sent out on a quarterly basis. K-1 tax returns are done on time before March 15th. You'd be amazed how much investors appreciate that. And just do what you say you're going to do. And if an investor texts you on a Saturday afternoon and you're spending time with your children, just say, hey, you know what? I'm not sure right now. I'll get back to you on Monday, right? Because you got to have a life too, right? But when you're working with investors, especially like not all family offices, but like, I don't know, I've had one family office, they actually never wrote a check, but he would call me like Easter Sunday morning just to like make sure I was paying attention. Yeah, he never even wrote a check anyway. He would just like tease it all the time. And like, you want to work with people that appreciate you, you know, and like don't like torture you, you know, and like hold a carrot over your head for some investment.
Sure.
But you know, I would pick up his call and I'd say, hey, you know, I'm with my family. It's Easter Sunday. Why don't we talk on Monday? You know, okay. You know, is there anything? Right? He wasn't even invested in our deals. He was just like circling the nest. So, but generally, I always communicate back with my investors, and I have a personal relationship with them as well. I know their children, their family, you know, for the most part. And you can't, as you get bigger, it's hard to do that. But, you know, you want to be on a friendly basis with your investors as much as you can, or hire someone in your company who could do that.
Sure. As you started working with bigger and bigger deals and raising larger amounts of capital, you know, we talked about the trust aspect, but operationally, how did you balance scaling your business with growing too fast and making sure you're doing right by every deal you're working on?
Yeah, that's tough. Having a good partner is probably a big part of that, right? And knowing your skill sets and delegating them wisely. You can't do everything, right? At an early start to our company, Seth and I, we knew our responsibilities in the company, and we stay in our lane. Seth is managing the management company. He's operations. Essentially, once we acquire the asset, he's running the project. And I'm off to the next one, raising the capital for the next deal. I have reports that are sent back to me. Seth and I talk almost every business day about, our business and our projects. My property manager is in the office here. I can always stop by with her, but Seth is managing her. I don't want to overmanage or get in between it or say there's, so you have to know your role in the company and not step on each other's toes, and be able to trust other people to do what they need to do and to fix the challenges that you're running into. I think there are, we could definitely use, I think, more resources we probably raise more capital, but you got to also keep your budget reasonable, and I see a lot of companies, they get these crazy overheads with big salaries and fancy offices, and then before you know it, they're not in the office space anymore or whatnot. You got to keep a lean, mean operation.
Yeah.
And that's what we do. We utilize virtual assistants. We utilize interns. We utilize people that are hungry and be, slow to hire and fast to fire as well when you're building out your team there.
Totally. Yeah. You mentioned something I wanted to dig into next, which is the technology side, virtual assistants. I'm curious, how do you think about using technology in your side of the business, the buying, the selling, the acquisition, disposition, capital raising? Do you have any favorite tools you use? Do you, how are you thinking about implementing technology into your day-to-day to make sure you stay lean and can still be, competitive in the market?
Yeah, I mean, I would say I'm not one of those like super guru AI guys. I have mixed feelings on AI. Like, I've tried to use ChatGPT to write my social media posts, and it just sounds like ChatGPT is writing my social media post. And you can tell when other people have some program that goes through and comments on your stuff using ChatGPT. It's but we do use, we use Excel to underwrite deals. We have an institutional level underwriting team. I use Upwork to hire most of our virtual assistants. We have a telemarketing team on the debt fund side to source deals. We use normal technology. The other day, I wanted to improve the SEO and the performance of my YouTube channel. So I went on ChatGPT, or I was looking to kind of write a book, and I was like, okay, let me get some ideas and kind of an outline on ChatGPT. So I try to use that. I would say we could probably utilize AI more in our business. But in what I do, particularly in raising capital, you got to be careful. People want to deal with people. This is their money. We do have an answering service that we use through Appfolio, but that's a live answering service. I have one gentleman who I'm thinking about teaming up with. He's kind of a young little whippersnapper, and he's gonna do this AI generated phone service to call 200 people he knows that are in high net worth individuals and invite them to an event. And I was like, all right, man, if you think that's going to get them in the door, fine. But all I know is when I get those AI chatbots calling me and trying to sell me something, as soon as I figure out it's an AI chatbot, I hang up, but he's got this voicemail that's AI generated and asks you questions and but you're talking to a chatbot, and a lot of you got to know your demographic too. I tend to deal with an older demographic because generally you have more money towards, the second half of your life, and you've created a certain amount of wealth. And that's who I tend to work with. And those people do not want to talk to an AI chatbot. They want to talk to to a real person and they know, they can trust. And that's what I offer them.
Yeah, no, that makes sense. And I think, where, at least from Crexi's POV, like we see a lot of technology being used to supplement that personal relationship, right? Let's say like you're looking for a deal, you want to be able to bring all this knowledge of the market to a potential investor. Technology can be used to give you more up-to-date information about the market you're looking to invest in, more things that augment that personal relationship, right? So I totally hear you on the AI is so many cool things that are coming up with, but people, especially in commercial real estate, still really want people.
Yeah. And you have a certain voice too. Like even when I'm doing like the Facebook post now, you can like tweak it. You can make it more professional, like shorter or funnier. And I play around with that sometimes, but like I just kind of end up usually going back to my regular posts because that's my voice. And I think, there's a value to, also if you use AI too much to like write your content, you lose that like craft. So
yes. Yeah. That is something I think about quite a bit in my day-to-day job as the content person here. So before we move on to more like what you're seeing going on in the market today, how has your definition of success changed over the last 10 years of you building your business?
Well, I think I used to look at success as being busy, and now I look at success as having the ability to not be busy, but still pay your bills. I used to look at success as just how much money can you make? And then I met people that are heirs of hundreds of millions of dollars, and or other business owners, people that had made hundreds of millions of dollars, family offices. And not all of them, but some of them were miserable. And I realized money doesn't buy happiness. And, happiness comes from within. In my opinion, it comes from having a higher power, taking care of your health, your mind, your body, having a family, being a father or a mother, and being good at that, loving your children. The happiness I get from holding my 3-year-old son will always surpass the happiness I get from seeing money in a bank account or closing a big deal and getting paid. However, I've also realized that you can be moving a lot of deals and getting big speaking engagements and doing this and having a great reputation. And one man once told me, don't pray for success, pray for money. He was right, because I'd always pray for success. And, success is great. You have a lot of friends and a good reputation. Guess what? Having a lot of friends and a good reputation doesn't put money in your bank account. At the end of the day, we do this to create financial freedom so that we can spend time with the ones we love and have some freedom in life to do what you want. So it's a work-life balance. It's financial freedom. It's doing what you love too. I also know a lot of doctors that make $500,000 a year, or bank auditors, and they make a lot of money and they're doing great. They have vacation homes and really nice cars and beautiful families that they never get to see because they work so hard. And, they're not really happy. They don't really like what they do. They just have to do it because they own so many liabilities now. They have to cover those bills. Once you make $500,000 and you build a lifestyle around making $500,000, you have to keep making $500,000 a year. So you can't slow down, and so I would say having that balance in life, having a higher power, being a good father or mother is really how you find happiness in life. It's actually less about money than you think.
Yeah, I love that. It's a good segue to talking about investment principles. So, getting into the market today, how has your thesis evolved in today's going-ons versus 5 years ago? Obviously, you started at the very tail end of the recession. What are you seeing in the market today, and how are you adapting your strategy to meet what's happening?
Wow. So apartment buildings are on sale. Commercial real estate should have a sign on every building and be 20% off, closeout sale. That's what's happening right now. If I had, a few more 100 million behind me, I'd be buying a lot more real estate. Now is the time to buy commercial real estate. I've been through different market cycles. I've seen the 2010 to 2016 cycle where everything was just, they were giving it away. And I just wish I had more money to buy more real estate back then and kind of do what I do now. Then I saw the 2016, 2020 cycle where it was hot and pretty much became, a seller's market, but it was kind of the medium sellers, buyers market, just a kind of a healthy market. Mm-hmm. Then I saw the pandemic and the 2020 to 2023 market where it was crazy and people were overbidding and the cap rates were compressed to ridiculous numbers and interest rates were super low and you couldn't get a deal. By the way, I hated that market. That market sucked for trying to find a deal. It was good to sell real estate, but it was a terrible market to build your portfolio in. I would take this market over that any day. Now we're in this weird place where residential real estate is still sky high, at least in North Jersey here. I'm about to go try to buy another home right now, and it's really crazy. Residential real estate in North Jersey, it's ridiculously competitive and high priced. Mm-hmm. I think in a lot of areas too, like in California where you're at as well. Mm-hmm. So it's that's where it's at. But commercial real estate, 5 units or larger, and even more so for larger commercial real estate, 50 units plus. Those deals are great. Rent is super high. Rent continues to grow, at least in North Jersey here. Mm-hmm. So your rent rolls are strong. Yes, the interest rates are a little bit higher than they were, previously, but they've come down a little bit, and they're ideally going to come a little bit more down. But you date your interest rate, you marry your purchase price. Right? You can never change your purchase price.
I love that. That was great.
All right. You date your interest rate, you marry your purchase price. Right. Right. So if it's on sale, buy it. If you can make sense of it, and a lot of the stuff we're buying right now, we use bridge debt for. It's not terrible. I just got a quote from Big Corp for 7.8 on some bridge debt, 70% of the purchase, 100% of the CapEx. Really leverage my investors' capital. I bought a 42 unit in December. I got a 5.4 interest rate on a Fannie Mae loan. I did a 2-point buy down, but locked in a great rate on that one. So you can make sense of this stuff. It's on sale. Go out and buy some apartment buildings right now. It's on sale. It's not going to be on sale forever.
Yeah. I mean, demand for it is going to keep going up as we continue to deal with this national housing shortage. But one more thing there. So the cost of buying a home is here. Yeah. The cost of rent is here. Mm-hmm. So everyone's renting. Yeah. People, less and less and less people are buying homes, especially in these high-end markets that we're in. Yeah. So that just pushes your rent up. Mm-hmm. So it's until house prices come down to a reasonable amount, which I don't see happening ever, people are just going to rent. It's a generation of renters that's being released into the marketplace now. So it's great to own apartment buildings. Yeah, especially in your neck of the woods, commutable to Manhattan, because in city rent is crazy. Yeah. So exactly. I'd love to know, in this very frothy market, it sounds like, what are some of the biggest challenges for you when it comes to underwriting a deal? Whether it's in terms of working with debt, people are still not sure whether interest rates are going to stay where they are, go down, go up again. Insurance is a whole other ball game. How are you thinking about pricing and everything? Yeah, insurance is ridiculous. Yeah. We basically, whatever a broker sends us for an insurance cost, we increase it by 75%. That's the real cost. But right now the hard part I'd say is we buy our deals, we refinance over 3 to 4 years. So we got to predict where rates are going to be in 3 to 4 years. So we basically assume the market is what it is today.
So we underwrite at a pretty high interest rate. Whatever you would be able to refinance into a stabilized asset, that stabilized asset today is pretty much what we price it out at for 3 or 4 years from now. So if rates are lower in 3 or 4 years, which I personally think they probably will be, then we would do better than targeted. The other thing is the resale value, right? What the heck is the cap rate going to be in 5 years from now? No one knows. So we price the cap rate at what the market is today. We basically assume you're dealing with a market that has increased cap rates, lower prices, increased interest rates, and that's what we're seeing today. So we price everything out that way. And that's how you have to price it out. Because if you go to any type of investor, especially savvy ones like family offices, and you say, don't worry about it. In the future, cap rates are going to compress, prices are going to go up, interest rates are going to go down. So this thing's going to make money. We're going to laugh all the way to the bank. No one's going to write you a check.
Yeah.
In fact, some of the family offices I work with are very worried about recession. Even when we price in a 2.5% rental increase per year, which again, these are within an hour commute to Manhattan. These are high demand North Jersey markets. Rent goes up like 5 to 6% a year in these markets. We price in 2.5% normal annualized increase in rent. We assume a 2% increase in expenses. Even that, when we stress test a deal, take that 2.5% growth in rent, put it to 0. Keep your expenses at 2% growth, right?
Yeah.
That's these stress test deals, right? Or increase your cap rate in the resale or whatnot, increase your interest rate of the refinance. So it's just, trying to predict where the market's going to be, not listening too much to all the talking heads. The media is trying to sell you something, whether you're left, right, or center. They're trying to pretty much scare you into watching their news channels. So you got to be careful on what the media is telling you as well.
Sure.
I do think we're going to see a much better economy, but it's going to take time. The current administration is trying to do something that hasn't been done perhaps ever, and then bring manufacturing back to the U.S. But it takes time. There's trillions of dollars planned to be invested in this country. And we need to see a little bit of progress. We need to see some of the tariff negotiations come through positively. We need to see some of those factories break ground. But as soon as those headlines start to come out, I think the economy is going to pick up. I think we're going to see a decent 26, a nice 27, and a very fruitful 28. And I'll probably just start selling assets at that point, because sell when the market's hot, buy when the market is down.
Yeah. It sounds like the thesis in shorthand is pricing or calculate things very defensively, but optimistically.
Yeah, and I love when everyone's like scared, like, Trump tweets something stupid or something, like everyone gets scared. I'm like, yes, that keeps my apartment building prices down lower for longer, so I can go out and buy more real estate like now, because if we go back to what we saw in like 2020 again, and prices skyrocket and like everyone's just outbidding deals like that, it's hard to make money. We make money by buying deals, right? And selling deals is really where we get paid. But if you're not buying deals for great prices, then if you can't find any deals, I didn't find anything. Like in 22, it was so hard to find a deal. In 23, we got one. In 24 we got one, but like now we're starting to see lots of deals.
Yeah, absolutely. And I'm curious, we can talk a little bit. I have a note to talk about distressed assets just because you started your career in doing fix and flips. But what does a great deal look like to you today? And is there anything you're willing to compromise on?
Yeah, a great deal is generally off market. We're the only bidder in the room. Value add, a lot of value add. You got to buy something that allows you to increase the revenue on the building. And generally that's low rents and outdated units. That's the simplest form of value add, most common. I'm willing to compromise on the age of the building, right? If something's built in 1935 or something, we're buying a 78 unit built in 1935. It is what it is. It's a great location. It's a big unit. What's interesting was you buy something built in the 1930s, a lot of those buildings, they're like these really big units, these really big apartments. What's happened now, if you buy something built in the last 20 years, the size generally of the units are much smaller, especially in the last like 5 years or so. We're trying to buy something that was built about 4 years ago. The units are like tiny. You go into these apartments, like they're beautiful. They're all brand new building, completely done up, lovely location. But the units are like tiny, new construction units. Like the bedrooms are decent sizes, but like the common areas are tiny. If you go to something built like the 1930s, 1940s, like they had like big living rooms, they actually hung out in there, like talked to each other, and like big eating kitchens and big bedrooms too. So I like older buildings that's one of the reasons why. Another reason you get it at much lower than replacement cost. Right. Replacement cost is the cost to build that same structure new. Where now I'm buying buildings at like 180 to like 190 a unit, where to build that same building new would be like 300 a unit, so I'm getting it way below replacement cost, which was not the case in, just 4 years ago or something. So I'm willing to compromise on the time it was built. What I'm not willing to compromise on is like value add. Like I can't just buy a stabilized asset. I need to create value for my investors, right? If I'm just buying something that's totally rented up to top dollar, nothing to improve on the asset, management's great. What the heck are we going to do to make our investors more money? Just sit on it for 20 years and wait, and assume the market goes up. Like that probably would work, but it wouldn't get our investors the 20% IRR we're targeting.
Absolutely.
Maybe if we were like a big pension fund or something, we could do that.
Yeah, you get to be more creative with the value add. Well, any Jersey brokers, if you're listening to this, you know who to call if you've got such a deal. He's laid it all out for you.
There you go.
So, being mindful of our time, we've had a really great conversation so far. I want to wrap up with a couple rapid fire questions just based on your expertise and experience. Are you game? You ready for this?
Oh, yeah, shoot. Yeah, bring it on.
All right,
yeah.
Really quick answers. I think we know exactly what this answer would be, but if you were handed $50 million today, had to invest it by the end of the day, 5 o'clock, where is that money going in real estate? What would you put it into?
I had to invest by the end of the day. That's ridiculous.
I know. Fun, right?
I would invest it in launching multiple funds, hiring wholesalers, broker dealers, marketing companies, and I would use it to raise money.
That's a great answer. That works totally.
Yeah, you would like 10x. You'd raise like $50 billion.
Yeah, invest in the business. And then, what is the craziest way that you found a client or a deal or an investor, whether through social media, anything, any fun, crazy stories?
In creative ways I found investors.
Besides stapling the posters on the lamp.
Yeah, sure. Yeah. How did I find? I mean, boy, that's a tough one. I'm trying to think of how I don't want to skip it. I don't know if they've invested, but I think we found them in a real estate network. I guess that being a realtor, I found, just kind of your standard ways. I don't know, unique ways you find investors. I may have to skip.
Like in the bathroom at some random building, or like one person who's fixing a chandelier is like, I want to buy this building. Will you be the broker on it for me? Or this weird stories like that. So, normal networking is totally fine.
As far as like brokering deals, I mean, I thought you were like talking about writing a check, but if
Just
they're
anyone in the network, what's the crazy?
Anyone at a business, I guess I need to talk to more people in the bathroom. Yeah, that's a good. I'm just gonna go hang out in the bathroom, the men's bathroom, just to clarify.
Yep, that works.
The women's bathroom, we probably get into trouble. So I'm gonna hang out in the men's bathroom and just solicit people for business. That's what I'll do after this podcast, based on your suggestion.
I neither condone nor recommend this advice. I'm just witness to it. And then finally, what is the most common misconception about what you do or commercial real estate in general that you've heard?
That we are like super wealthy and rich. People say, "Oh my gosh, you own $40 million in real estate. You have $40 million," and you're like, "No, bro, I wish." Nah, it's assets under management. You can own $40 million in real estate and be in big trouble financially, right? If you're over leveraged or mismanaged it. So it's a misunderstanding of how much you actually make when you syndicate and own real estate as we do.
Sure. It's the stakes are just high.
Yeah. You got investors, you got lenders, so you get a little piece of the pie at the end of the day.
Absolutely. Oh man, Aaron, this has been very, very fun. Any parting words you have for our audience before we wrap up?
Well, if you are in the tri-state area here, we're pretty active. Our network, New Jersey Real Estate Network, is on meetup.com. People can check us out there. And we have an event coming up the last Wednesday of June, which is going to be in Somerset, New Jersey, the Jersey Cyclone Brewery at 6 p.m. That's our major real estate networking event. So we get a good amount of people out there, realtors, brokers, investors, just people in and out of the real estate industry. We do that. I do a monthly masterclass, generally about a different investment topic every single month. So, again, you can find us on YouTube. My podcast, the Passive Cash Flow Podcast, we come out with an episode every 2 weeks for that. And, that's on all the major podcast platforms. So we try to put out a lot of content. Our website, peoplescapitalgroup.com, has ebooks and things like that. It's all free. We don't sell any education. But we're pretty active in the content space and the event space. We do investor walkthroughs twice a year as well. We just did one in Passaic. We'll do another one in September for another building. So it's pretty cool. We walk through a building we're renovating. We show investors how and why we're doing it and the reposition strategy. So, you can get in touch with us there and we'll let you know what events we have coming up.
Fantastic. Sounds great. Aaron, thank you so much for spending the time sharing your insights with us. Really, really appreciate it. I had a lot of fun. Hope you did too.
Absolutely. Shanti, thanks for having me. I had a great time.
Yeah. And thank you everyone who tuned in today. If you enjoyed this episode, please do not miss the next one. Visit crexi.com/podcast and sign up to get the next episode delivered straight to your inbox. You can also subscribe to the Crexi Podcast on your favorite podcast app or check out our YouTube channel for video recordings of each episode. Take care and be sure to tune in next time.